Hello guys, my name is A.i.Gideon. A lot of people call me Gideon or EJ, whatever you prefer. So I'm going to be teaching this class, basically passing on what I know, right? To I prefer to say my fellow Africans, right? Because I want them to be successful, know how to make money, right? So I'm not an expert, I'm just an ape trying to teach another ape how to eat a banana. So I might be wrong. If you feel like I'm wrong in my explanation or whatever it is, for those of you that are gurus and are pros on how to trade, right? That's I'm not perfect. Correct me. Leave a comment, whatever it is. Then we all learn. I'm learning. You're learning. But this is specifically for people who are brand new into trading, who want to be able to at least look at the market and know what's going on. Okay, all right. So jumping in, without wasting any time. So two things that we need to understand here when we're trying to know how to look at the market is demand and supply. So demand and supply. Excuse my handwriting. So before we jump into demand and supply, something that is very important for us to understand, very, very important, because we're going to build off this, and this is the very foundation. This is called candlesticks. So candlesticks. Okay, so let me explain these candlesticks. So basically, let's say we're trying to buy a commodity, right? I like to use Bitcoin because that's what I like. So let's say this Bitcoin right now is going for $100, right? Let's say it's $100, right? Here is where we're starting off from. Where we start is called the opening. This is where the market opens up. So the opening price for Bitcoin right here is $100, right? Now it goes up all the way here, right? And now it's $500. 500. This process of it going up is called bullish, right? Bullish. And let's say it goes down, and now here it's $50, right? This process of it coming down is called bearish. Now remember this, you're going to see this over and over. Oh, it's bullish, it's bearish. And people say that, what they're talking about. Bullish means it's going up. Bearish means it's coming down. Sometimes you hear bulls, sometimes you hear bears, right? Like the animals. Depending on where you are, like if you're in Europe or whatever, some people use, the word dovish. Dovish. Some people use, so dovish is it's the bird. It likes to go up, right? And there's another word here. I can't really think about it. It's another bird that comes down. No, sorry. I'll take this back. So that's one mistake. Don't crucify me, right? So dovish is when it's going down, right? Doves like to come down. When it's going up, hawkish. Hawkish. Not really so significant. Just so when people are talking, or market people are talking, and they say, oh, the market is hawkish, or bullish. It's up because hawk like to fly high in the sky. When it's dove or bearish, it's coming down. Okay, so now let's just draw this like this. This is how you see it. So this is a candlestick, right? So usually it is color coded, right? And it's usually either blue, green or red. Green is usually used to signify bullish. Red is usually used to signify bearish. That means the market is falling. Now this color doesn't really, determine whether or not you're making profit. Depending on how you trade, it can be bearish and you're making money. It can be bullish and you're losing money, right? But a lot of times when it's bullish, people are making money. When it's bearish, people are losing money. Okay, so I don't have color markers. I would love to color it to make it easier for you to understand, but just by listening, I think it will be easy for you to understand. So basically, this is a candlestick, all right? Okay, so I just realized I actually have blue and red. So I'm going to use red to signify bearish, blue to signify um, bullish, right? However, a lot of times you see green instead of blue, but this is what I have. Okay, so let's say we have a market situation here, right? I call it a market situation right here. I don't want to mess with this yet, so that way you're looking at it and it's all making sense. Let's say this is another candlestick, right? Sometimes it's like this, right? Sometimes it could be like this. So what's happening here is, and that's red and blue, but typically green, but you get what I mean. So what's happening here, right? So the market opened here, right, at a certain price, and then it fell all the way down here at this price, and then it later came all the way up here and settled here, and this is the price, people are paying for. This is the price right now, right? So it helps you to understand the psychology of what's going on. This candlestick right here, because if the price here is $500, right? Let's assuming this is Bitcoin, assuming this is one Bitcoin, right? Right? If the price here is $500, what you understand from here is at some point it came down here to it started here at $100. At some point it came down here to $50. So some people, this much people believe that Bitcoin should be $50, right? But we're not able to agree, and then they're able to pull the price up all the way here. So now the price is 500, but it helps me to understand that this much people believe that this shouldn't be 500. So how do we end up here, right? We're looking at a lot of things that come into play for us to come up with this price. We look at averages, right? Who has the most weight? The person who has the most weight is the person who determines the prices of the commodity. Yeah. So, and I'll explain that, right? So, let's say, for instance, you have four people, right? Four guys, and each of them has, let's say, this is one guy, right? I'm using stick figures here, right? Basic stuff. So now, this is four guys, right? He has 10 Bitcoin. He has 10 Bitcoin. He has 10 Bitcoin. But this dude right here has 100 Bitcoin, right? So if all of them decide to sell their Bitcoin, who's going to have the most determining say? This guy here, obviously, right? So a lot of times, right, you see a situation whereby, the price goes up or down. It depends on, the market forces, right? And, who's, another thing I need to explain real quick before I forget is the size of this candlestick, tells you how much people are in the market, right? Or how much volume, how much strength. So if the candlestick is so big, if it is a massive candlestick, one big candlestick, right? It tells you there's a lot that you can understand here. If the candlestick went from this, and then now you're seeing this, right? It tells you that people have left the market. Now you have lesser people in the market, right? So very important to understand that. Okay, so I'm going to clean this, right? But I'm going to come back and reference a lot of things, and I have to write them back again, and it's fine. You can always go back and rewatch this video. So moving on. Okay, so we talked about those four guys. We talked about four individuals that have Bitcoins, right? So So this guy has 10, 10, 10, and this guy has 100, right? So we're moving into averages. So average. So to get a price of Bitcoin, we need an average of all the Bitcoins, right? So in this case, right, it will be, 100 plus 10 plus 10 plus 10 divided by 4, right? So this is how we get the average, right, of all the Bitcoins with all the people that's available. So why is it important that we know this average, right? This average is what we use to understand, to calculate, or to predict what the value of the commodity will be, right? So there is an average, right, which is also called the mean, right? This is the statistical term, the mean. You also have the mode. You also have the median. Now, these are called indices. These are indexes, when basically means of understanding where the market is going. We also have the range. And this is I love the range, because range is very important to understand, right? Let's say we have a situation here, market situation, whereby this Bitcoin right now is worth $500, right? Here it was 100, right? Here it was 50. Now, so for you to understand the range, we'll look at the difference between the highest price versus the lowest price. That is the range. So let's say there's a bunch of people in here, right, that made this a candlestick. Sometimes this is represented daily. Sometimes this candlestick represents monthly. Sometimes it represents hourly, depending on how you want to look at the market, right? You want to see, the market can shrink it down to a candlestick, and it can also shrink it down to a bigger chart system, which I'm going to explain down the line. But basically, the range here would be the highest that this was paid for versus minus the lowest. So it will be, range would be 500 minus 50. So the price is 450. So some people would say the price of Bitcoin should be 450 because they minus this, minus that, and then they say this is the price that they are willing to. So let's say they bought their Bitcoin for $100, right? And it went up and went down and went up and that, So some people will say, let's say it hasn't gotten to 500 yet. Let's say right now it's at 300, somewhere here, right? Let's say it's at 300. Some people will say, well, because earlier yesterday, somebody paid 500 for it, then that means the value should be 450 if you minus the lowest price, from the highest price, right? Now that's, when they say, oh, what do you look at? What do you look at when you're trying to understand the market? This is one way. So I've explained the range, right? Even though I started with average, sometimes that's how I go, but I'll circle back to the same thing. So we understand the range now, which is the difference between the highest price and the lowest price. Now, some people would say, you have 4 guys here, right? What do we have in common? 10, 10, 10. Some people will say the price of Bitcoin should be, or the price of the commodity should be 10, because we have 3 people who are saying 10, right? And 1 person who is saying 100, right? So now in that case, this would be the mode, the one that appears the most, right? So if you're looking at the price, and let's say the price Bitcoin was ended with 300 yesterday, 300, and then tomorrow 400, and then next tomorrow 600, and then maybe down the line it came down to 300 again, and then the next day 300 again, right? So some people will say that looking at these 4 prices, 400, 600, 300, 300, likelihood the value is 300, the price is 300. So some people might decide to look at 450, 300, and then even say 450 minus 300 and say the price should be somewhere around, 400, or 420, because they are doing the difference between. So it's up to you, right? So when someone says, how do you trade, right? That is, it's very hard to explain that question because some people look at so many different things, right? So what I'm teaching you now is the little that I know and how you can also look at several other things, combine this knowledge and come out with a more accurate, because what we're looking for is precision. Who's more precise, right? Who can predict more based off what they look at. So I've explained the average, which is if we add all the prices together, we divide by the amount of people, right? That's the average. Then, so if we're going in a consecutive manner, the median would be basically you're going to add up the two that is in the middle. If we're going in a consecutive manner, so it will be 10 here plus this 10 plus this 10, right? And we'll divide by 2, and that will be the median. Now, but that's not used very often compared to the mean, the mode, range, and several other indices or indexes that we have out there. Okay, so this isn't so clear, but I'm sure you can see it, and I'll explain. And if I have to draw it to make it bigger, I would. So basically, this is a linear graphical representation, right? Basically, what you're seeing right here is a linear graphical representation, but it can be expressed. It can be expressed in form of a candlestick, which is why candlesticks was important in the very first place, right? But now we're moving forward, and you start to see graphs. Sometimes you see, let's say this is let's do this. I'm going to draw a graph here, and sometimes you see this, right? This is what's going on here, and each circle is a different month, right? What happened, right? So a lot of times you see, and this is represented like in months. So January, February, March, April, May, June, July, August, September, right? So, and then the price here, let's say the price here is $5. So this is price. And then here, 10, 15, 20, 25. So a lot of times we do this, right, to help us understand what's going to happen next, right? So this is where average is very important, because with the average, we can say, okay, this is what's likely to happen, right? So we can calculate the average of all these numbers, right? And say, okay, this is what the next month is going to be, or likely to be, right? Because we're calculating the averages. So let's say you hear a situation where you hear moving average, right? So sometimes it will be very specific. You hear 5-day moving average. What does that mean? That means they calculated the prices of the last 5 days, right? And they did the average of those prices. Some people do go with 20-day moving average. Some you hear 40-day, 50-day, 100-day, 200-day moving average. And it's up to you. If you want to calculate the whole thing, right? It's up to you. But it might not be precise, because what happened 10 years ago, is different from what's happening today. So the market forces have changed, right? So very key, demand and supply. If this Bitcoin was in demand 10 years ago and today it's no longer in demand, of course we expect a change in the moving average and how things are going to move, right? Things might become bearish, things might start to fall. So very important is, regardless of all this analysis, all this stuff we're trying to understand, very key is it in demand? And is there a supply for it? Because if I don't want this, if I don't feel like there's a need for Bitcoin, then why do I believe that Bitcoin should go up? But if there's a need for Bitcoin, then we know that, okay, regardless, it's going to go up because there's a need. Now, what we're trying to determine is, okay, we established that there's a need, right? That it's going to go up. Now, the next question is, how fast is it going to go up? And what is it going to go to? right? So we've cleared the doubt of it not going down, right? Which is very important because that's the first question you ask yourself: is this a need? What is this about? What can Bitcoin do? Now I have several, I might have a teaching on that later on you know, how to know, I guess, whether a commodity is, valuable or not, right? That depends on the community, the developers, the industry. There's so many things at play. Okay, so let's say to calculate the average of this, right? Let's say this is $5 here, 15 here, 10, 20, 25, maybe 15, 10. So basically what we're trying to do here is we take all these numbers, right? So let's say we can say 5 plus 15 plus 10 plus 20 plus 25 plus 20 again plus 10 plus 10 plus 20. So basically the average, right? The average of this would be all these prices divided by how many times? So basically 1, 2, 3, 4, 5, 6, 7, 8, 9. 1, 2, 3, 4, 5, 6, 7, 8, 9. Right? So then we'll say divided by 9. So when we add this all up, right? When we add this all up, whatever price that we get, right, is what's going to likely come here next. So we're trying to calculate the next month. This is September, October is what we're trying to calculate. What's likely going to happen here? What's the price here? Because once we can get the average of this, right, then we can determine how we're going to come in and go. So let's say you calculated the average. Now, you then look at the price here. It was 25. You look at the lowest price here, it was 5. Some people will say 25 minus 5, that the next price should be around 20. What is that called again? That's called the range, right? We talked about that earlier. So how about the situation whereby, I'm going to move this away. The situation whereby instead of it to come here, it went up, and then now, you're like, whoa, here, the price here is 500. Does this matter? Right? Some people believe that this doesn't matter. Some people will cut this off and say, this is too volatile, that there was some volatility here. What's going on there? Right? So some people don't want to add this to the whole thing. Some people will say, well, it's part of it, we'll calculate it, and they add 500 there and they add it all up. So in order to understand, to get more precise, I guess, value on what's coming next, this is where we now calculate standard deviation. But I don't expect most beginners to know what that is. But standard deviation helps us to understand how to cut off things like this, right? That we call this volatility. It's volatile, right? So that's another key term, is volatility. Some people want to know how volatile the market is, while some people want to know, whether they should enter or not. So some people like a volatile market. Some people will tell you, I want to be able to get 300% profit. While some people will tell you, that's a big risk, because if it can go 300% up, that means it can also go maybe somewhere here 300% down. Who knows? So the more we see things like this, the more we say this market is not stable, it's volatile, it's risky. But some people like it. Some people want to be able to get into a volatile market, make their money, and retire. So, mind you, sometimes the market goes up this way and stays up, and then when you're expecting it to come down, it goes and then continue going up. You're like, what's happening? We will think that it has peaked, that this is a plateau. You know what happens in a plateau? A plateau is usually like this, right? It goes up and come down, but then it goes up and then it keep going. You know, so there's several things here, market forces that or price action, right? Sentiment. There's what they call FOMO. You know, FOMO. You hear that a lot. FOMO. FOMO means fear of missing out. A lot of people believe that, man, this went all the way up suddenly, right? 200%. Some people will quickly jump in. They jump in without looking at the market, without understanding what, that it was once here, without looking at all these other key figures. They just look at this price and they're excited and they jump in. Now, old timers, people that have been in the market will say, at this point, this is overpriced, right? If you look at all this here, if you're giving all this here, this is called overpriced. It's overpriced. It's just overpriced, right? When it starts going up, this is when we just watch it like a TV show, like, well, let's see what happens. A lot of people here will pull their money out because it becomes a risky asset, But some people just like it. Some people enjoy the thrill. It's something that was once $5 has jumped to 500 and it's still going. It's exciting. You're like, whoo, adrenaline, the thrill, you want to stay in it. So, but a lot of people smart people would come out. Some people would take their chances and say they'd rather die here. We die here. Anyways, if the price falls down below, very similar, the way it's overpriced here, if the opposite happens on the other end and it falls down all the way down, then we'll call it underpriced, right? So how do we know something is overpriced and underpriced? We know through looking at the RSI, the Relative Strength Index. It tells us exactly whether it's overpriced or underpriced, right? And we know by looking at, the averages, what's going on here, right? Compared to the other average, what is the current price? If the average is normally 25, right, or 20, and now you're seeing 500, that's overpriced. However, it's one key thing, remember, is demand and supply. If the demand is high and the supply is low, let's say, for instance, we have 500 bananas in the market, and we only have, somebody came all of a sudden, and we're buying the bananas one by one, right? And then now we bought 200 bananas. 300 bananas are left in the market. After the 300 bananas are gone, there will be no more bananas, right? One big guy came in and bought 100, and that big guy came in and bought another 100. Now we have only 100 left, right? You might see this big jump because one big guy came in and bought up most of it. So what happens when that one guy decides to sell? It's very easy for that one guy to sell. The guy says, I want to sell, and he starts to sell his bananas, right? Because he has so many bananas, right? He can determine and affect this market price because he can cause fear and uncertainty. That's another one you hear. You hear FOMO, fear of missing out, and then you hear fear and uncertainty. When there is fear and uncertainty, people don't want to jump into the market because they're like, well, we're not sure. Just like when Bitcoin dropped all the way to 16, everybody was like, wow, a lot of people lost money, right? So at that point, there's a lot of fear. But now Bitcoin is going back up, right? There's a lot of greed. So it's either you're afraid or you're greedy, one of the two. So when it's running up like this, yeah, we've called it overpriced, right? So what we're waiting for is for it to consolidate. Consolidation means when we meet an average price, agreeable price. So if the price went up this way and got here, sometimes it needs to come down here. Then we'll say, it has consolidated here. Then before it will now start going up again. What does this mean here? Why do we call this consolidation zone? Right? It means that the people that are trying to sell, the people that are afraid that this has gone to the highest point, they've sold and they're out. Why the people that bought it still believe that this should not fall less than 500? Right? So we'll say it has consolidated. So sometimes the consolidation may come to the average, to the middle, right? So sometimes it consolidates towards the middle of the highest and the lowest. Sometimes the consolidation goes all the way low, right? So I'll have to explain that. Okay, so again, this is another small image, but I'll draw things and explain. So let's say it's just like there's multiple patterns here, multiple charts here, but I'm just going to draw. Let's say we have a candlestick, and I'm going to use a daily candlestick, right? And let's say we're seeing this. Right? So some people would, another thing that's very important is trend lines. Some people would draw trend lines, right? To tell you, to kind of like understand that. Some people would draw a line here. Like from this point to this point, to this point, to this point, and then draw another line here. And tell you that this is how the market is moving, that the market is moving like this. Right? So why do we need to know that? We need to know that because, if we are currently here, we know that we can buy here, and then once it's going up, we can sell. I wouldn't recommend you sell here at the line, right? Because it might not touch this line. Sometimes, you'll be lucky. Sometimes it might even pass the line and come back down. Sometimes it might stop right here before it comes down, right? So some people will buy somewhere here and then sell somewhere here. So that's why, trend lines are important. I don't look at them as so precise, but they are very, very effective, right? If you know how to use them well. So this is one instance of a trend line, knowing what's likely to happen, right? By drawing a trend line, right? So now we've explained what's happening within a candlestick. We've explained moving averages and why they're important, right? So now we're just looking at patterns, right? So we're looking at patterns. Let me just write that down here. Because from some people study these things, with patterns, you can tell what's more likely to go on. So for instance, have you ever heard of a bull flag? So a bull flag is usually like this, right? Let's say this is a candlestick, right? It will form in a flag-like manner. As it's forming, you notice something. It's getting smaller and smaller. The candlestick is getting smaller and smaller. So this is one candle. Then this is another candle. This is another candle. Then this is another candle. Then this is, whichever way, sometimes it's, So when we see something like this, we say it opened here, right? Remember when I was explaining candlesticks, the market opened here at a certain price and it closed at this price up here. And then let's say this is Monday. Tuesday, the market now opened here, closed here. Wednesday, this happened. It opened here, it closed here, but at some point it came up here. So it's telling us that this wants to go up. Some people still believe that this should be up, but now it ended up here. So same thing, similar happened on Wednesday, Thursday, Friday, Saturday, and then maybe on Sunday. Now you see that it's so people are not even at this point. This is called consolidation. It has gotten so thin. People start to get excited here. When it comes to this point, this is usually where we'll now, you see this can just rocket up, right? It will rocket up. So sometimes we might draw a pattern, or we just understand that this is we draw a pattern here, and we say this is a flag. Yeah, that's what it looks like. It's a flag, So a lot of times when you see a flag, this is what happens. It runs up. So sometimes you don't need to know what's happening within the candlestick, but I've explained it anyways. It's not that big, it's not rocket science even, and even rocket science is not that difficult, to be honest. But I've explained it so that way you can actually see what's going on. Because looking at it, let's say this is what happened in a week: Monday, Tuesday, Wednesday, Thursday, Friday, Saturday. This is what happened in a week, right? Now, you want to see what happened inside here on Sunday. You can open up that Sunday and make it, show you what happened like this in chart form. So sometimes you're looking at the weekly chart. It's not, you can't make your decision whether or not this is bullish or bearish. You might have to open up the daily to see what happened inside that day, right? So I'm going to explain a few patterns, right? Because there's so many out there, but we can't go through all of them as time goes by, and you guys get more used to me. Maybe I'll explain more. But let's just look at we have a pattern here. Let's say this is so here. This is another one, very popular one. It's called, what you can see here is a cup. We call it a cup and handle, right? So cup and handle, right? Very important. We need this handle, right? Because this handle tells us that it's complete. So if you look here, it's a form of a cup, right? And this is the handle, right? So when you see this, a lot of times it has consolidated. It means, well, if you want to look at the candlestick, you can analyze that, but this doesn't have any meaning because I'm just doing a sketch, right? But you can look at each candlestick to know what's going on in each day. You can draw these averages of these prices, right? And do whatever statistics, whatever you want to use and apply, that's fine. You can also say, well, the price started here, opened here, came here, here, then here. We can see that people are a little bit, and then indecisive from here, it came here. So we can draw another pattern here. If you look well here, there's a pattern, right? So this pattern right here is called the pennant. Before we even form the cup, if you look here, it was like almost like a triangle, right? We're seeing this. That is almost like, it's called a pennant. Right? So the pennant formed, which is one bullish indicator, right? We saw a pennant, that's bullish. And then next thing, it formed this other part, and started creating a cup, right? So when it gets here, a lot of times, so this is one, way, and there's a lot of patterns here. I'm sorry you can't see this clearly here, right? But there are several patterns that just like this, that people would see and say, wow, that's looking bullish. Right? You might decide to look at your chart on the daily. This might be a daily representation. This might be hourly representation. This might be weekly representation. So sometimes it's just a waiting game. Maybe you looked at it and you're seeing the daily representation, but or the daily representation, right? You're looking at the daily representation. Like look at here now. For instance, here it fell from here. Let's say here, right? It's or here. Let's say here it's 500, right? And then now it has come down here now to 100. Some people will say that it's falling. Look, it's now 100. But people that know how to look at the markets would not sell yet. They will wait because we've waited this long. Look at what's forming. We have a cup and handle, right? That it will soon run up. Be patient. But some people will be so scared and exit the market here. This is the best place to enter the market. Another one, I wanted to clean this up real quick. Another one I wanted to explain that is it's called head and shoulders. So sometimes you see a candlestick So sometimes you see things like this, right? And it's actually here. It's easy to understand here. It's, if you look at it, right, it looks like an M, right? That's what's happening here, like an M. So if it came from here, right? If it came from here and it's gone up, right? Several things can happen here, right? Let's say this is 2013, 2014, 2015, 2016, 2017, and so on. Within this year, some people have made millions. Within this year, within a month, some people have made millions. So however you want to look at the market, sometimes it's good to look at the big picture, yearly, look at what's happening in the year, look at what's happening in the month, look at what's happening in the day, to know if I'm going to be in the market and how long I'm going to be in the market before I see profit. Because here, if this is 2013, right, and you can see what's happening here. This, let's say 2013, 2014, 2015, right? People here, let's say the price of this here now is 500, right? And this is, 13, 14, 15, 2015. Let's say this is 2015, right? And this is 16, and this is 2017. So at 2017, right, the price is now $5. Look, from 2015 to 2017, that's a long time. A lot of people would have given up. Some people would have sold it and said, I'm just going to take my loss. They bought it for 500 or they bought it for 450 or something, and now it's $5. So they run away. They'll just say, this is going down. Because look how long, from 2015 to 2017, it's been going down. Right? But you see here, let's say the price here was $100, and here it was 200. Some people here would quickly enter here, buy this commodity at $100, sell it at 200, and sell it and get out of the market. And they will come back here, buy it at $5 and sell it at $100, and then they get out of the market. Your trading style, your trading strategy is up to you. Some people want to be in the market for a long time. So some people will buy it here and then wait 2018, 2019, 2 years. Some people will buy it here at 2013 and wait how many years? 5 years before they take their profit. It's up to you when you want to come in and when you want to go out. Your buying style, based off what you know and how you look at the market, you can choose when to come in and when. But now, before I go on the tangent, we're looking at this pattern here that formed M. And this is the head, right? And this is the shoulder. So when we've seen, a lot of time when we've seen a shoulder here, and we now see something like this, plateau. Oh, this is a plateau. We didn't see it go like this again, right? Now it's coming down. Whoa, it comes down here. At this point, right, a smart trader can say, okay, I'm going to buy here. It's going to come down regardless. But a smart trader can buy here and sell up here and get out. And get out here before it comes down. So that's why it's important, right? So sometimes you see this head and shoulders. Sometimes you see it in reverse, right? Reverse means, the way you're seeing the letter M right now, it can be in a form of W, like this. Right? Sometimes it's like that. Sometimes it's like. So when it's in reverse, we call that reverse head and shoulders. Right? Sometimes it's just head and shoulders. So this is why patterns are important. So thank you very much for listening to me. There are several other concepts and several other I guess constructs that we can use to trade. However, this is just the basics. There's advanced knowledge out there, but this for those of you that are wanting to at least know how to look at the market, right? This is it. It's not rocket science. You download a trading app. You can use this knowledge here to trade Bitcoin. You can use it to trade stocks. You can use it to trade forex. Whatever it is. Options. But you need to understand these things because the market right now nowadays is very volatile. We talked about a lot of good stuff here. Sometimes some trading platforms won't show you candlesticks. Like I think at the point Robinhood wasn't showing candlesticks, but now I think they're showing candlesticks. So you have to look at the options, right? The future, whatever you're using to trade. Some trading platforms will just be like, instead of showing you a candlestick, they can just show you this, and you're like, what's going on here? You can't really tell, or they show you this, right? So, but with our knowledge, we can see that okay, this is a cup forming here, right? So it's just showing you a line, right? And it's just a representation, right? Because it's like, why are we putting candlesticks? Some people believe candlesticks are for, ancient people, ancient folks, right? So some trading platform just shows you the market going up, right? So it's up to you to, use the right trading platform. And we'll continue later on. And if more comes out, I'll definitely share with you guys. Thank you very much for watching my videos.